In 2026, a married couple where both spouses have already turned 65 can pull roughly $47,500 out of a traditional 401k and owe nothing at all in federal income tax on that money. Not a reduced rate, not a discount, nothing. And the overwhelming majority of people who could use that room this year will not touch $1 of it, because nobody at their bank, their plan provider, or their human resources department has ever put that number in front of them. Here is the number nobody put on the chart, and here is exactly where it comes from. Because I want you to be able to check every piece of this yourself. For 2026, the standard deduction for a married couple filing jointly sits at approximately $32,200 after the annual inflation adjustment. If both spouses are 65 or older, the tax code hands you an extra standard deduction amount of roughly $1,650 per spouse, so another $3,300 on top. Then there is the piece that is new, temporary, and almost completely missing from the retirement conversation. An extra senior deduction of $6,000 per person, age 65 or older, created by the tax legislation signed in 2025, available for tax years 2025 through 2028, and phased out for joint filers whose modified adjusted gross income climbs above $150,000. Stack those three pieces together, and a 65-year-old couple is sitting on roughly $47,500 of income that arrives at a 0% federal rate. For a single filer 65 or older, the same stack comes to roughly $24,150. Now the part that changes everything. That room does not roll over. It is not a lifetime allowance. It resets on the first day of January, and whatever portion of it you did not use in the prior year is gone permanently. You cannot carry it forward. You cannot bank it. You cannot ask for it back at 73 when the Internal Revenue Service starts telling you how much to withdraw and taxing every dollar of it as ordinary income. And that is precisely what happens to most people. They retire at 63, 65, 67. They live carefully off cash, off a brokerage account, off Social Security. They feel disciplined for not touching the retirement account. Then the required minimum distribution rules arrive, and the government chooses the number, chooses the timing, and chooses the tax rate. And every one of those 0% years they left untouched has expired. I am Pierce, 25 years as an accountant, corporate tax, small business books, individual returns, audit prep. 25 years of looking at the inside of other people's financial lives, which means 25 years of watching the same specific mistake walk through my door in a slightly different suit. The mistake is almost never greed, and it is almost never laziness. It is a person who was careful their entire life, who was never shown the shape of the tax code they were saving into, and who made their very first retirement withdrawal in the most expensive way available to them, without ever knowing there was a cheaper way sitting right there. By the end of this, I am going to give you something I call the PAYR method. 3 steps, specific dollar figures, and each one takes less time than a trip to the pharmacy. I will explain it when we get there, because the number means nothing until you understand the machine underneath it. Let me start by validating something, because I do not think the people watching this are careless with money. According to the Federal Reserve Survey of Consumer Finances, the median retirement savings for Americans aged 55 to 64 is $185,000, and for those aged 65 to 74, it is $200,000. Over half of American households, around 54%, report no dedicated retirement savings whatsoever. As of the fourth quarter of 2025, Fidelity reported the average 401k balance across all participants at $146,400. If you have a retirement account with real money in it and you have been feeding it for decades, you are not behind the country. You are ahead of most of it. And a 2025 survey from the Employee Benefit Research Institute found that only about 28% of American workers are very confident they will be able to retire comfortably. So the anxiety is nearly universal, even among people whose behavior has been correct for 30 years. Your behavior is correct. The system is not. Here is the mechanism, and I'm going to prove this with numbers. Every dollar that comes out of a traditional 401k or a traditional individual retirement account is taxed as ordinary income, not at capital gains rates, which are generally lower, not at qualified dividend rates. Ordinary income rates, the same rates that applied to your paycheck. But ordinary income does not get taxed at one flat rate. It gets stacked. The first slice of your income is wiped out entirely by your deductions. The next slice is taxed at 10%. The next slice after that is taxed at 12%. Only after you fill those layers do you reach 22%, and then 24%, and upward from there. For 2026, a married couple filing jointly pays 10% on roughly the first $24,800 of taxable income and 12% on income up to roughly $100,800, with the 22% bracket beginning above that. Layer that on top of the deduction stack I described a minute ago, and here is what that couple actually has available in a single calendar year. Roughly $47,500 taxed at 0. Then, roughly $24,800 more taxed at 10%, which costs about $2,480. Then, another $76,000 taxed at 12%, which means that couple could move well over $70,000 out of a pre-tax retirement account in 1 year and never touch a rate above 12%. Now compare that to how the first withdrawal usually happens in the real world. Somebody retires. 2 years pass. The roof needs replacing, or the daughter is getting married, or the truck finally dies, and they call the 401k provider and request $40,000 in one shot. The call takes 11 minutes. Nobody on the other end of that call asks them what tax bracket they are in. Nobody asks whether they have taken any other income this year. Nobody asks whether their Medicare premiums 2 years from now are sitting near a threshold. The provider is not required to ask and is not paid to ask. The money arrives and something else arrives with it. An automatic 20% federal withholding, because the tax rules require plan administrators to withhold 20% from most eligible rollover distributions paid directly to you. So the person who asked for $40,000 receives $32,000 and then has to solve the gap out of somewhere else. That withholding is the part that quietly ruins the recovery attempt. Say that person realizes the mistake a week later and decides to put the money back by rolling it into an individual retirement account within the 60-day window. To make that whole, they have to deposit the full $40,000, including the $8,000 they never received, which is now sitting with the Internal Revenue Service as a credit they cannot use until they file. If they can only replace the $32,000 they actually got, that $8,000 becomes a taxable distribution. And if they are under 59.5, it also picks up a 10% early withdrawal penalty. A single phone call with no bad intent, no reckless spending, and no market crash involved has created a taxable event that will follow them into their filing, into their Social Security taxation calculation, and into the income figure that determines their Medicare Part B premium 2 years down the road, because the income-related monthly adjustment amount uses a 2-year look back. None of this is exotic tax planning. This is the plumbing. And almost nobody sees the plumbing, which brings me to the way I want you to hold this concept for the rest of the video, because the arithmetic will not stick until the picture does. Think about a parking garage downtown, the kind attached to a hospital or a courthouse, where the first stretch of your visit is validated free. You pull in, you take your ticket, and there is a window of time where the garage costs you nothing at all. After that window closes, the meter starts and it climbs in steps. A little at first, then more. Then a rate that makes you wince when you see the total on the way out. Here is the part almost everybody forgets. The validation resets every single day. If you park for 10 minutes and leave, you did not save your free time for later. It simply went unused. It vanished at closing. And if you avoid the garage entirely for years, because you are being careful with money, and then one afternoon you have to move every vehicle you own into that garage at once during the busiest hour of the busiest day, you will pay the highest posted rate on almost all of it. And the attendant will not stop you to mention that you had free hours available every single day you stayed home. That garage is the federal tax code, and your retirement account is the fleet of vehicles. The free validated window is the deduction and low bracket room you get handed every January. The escalating hourly rate is the bracket structure. The busiest hour of the busiest day is age 73, when the required minimum distribution rules stop asking you what you would like to do and start telling you. Most people are not being punished by the tax code. They are declining a benefit they do not know is printed on their ticket. And the amount they decline, year after year, quietly, without a single statement itemizing the loss, is the subject of the rest of this video. I want to prove this with numbers, and I want to do it the honest way, which means changing exactly one variable and holding everything else identical. Same people, same account, same market return. The only thing that moves is the calendar year in which the first dollar comes out. Meet Robert and Patricia, both 66. Both retired last year. $1,200,000, sitting in a traditional 401k from a 34-year career, which puts them well above the median for their age group, according to the Federal Reserve Survey of Consumer Finances. They plan to claim Social Security at 70 for a combined benefit of about $48,000 a year. Between now and 70, they are living off a cash reserve and a small brokerage account, so their taxable income is close to nothing. I'm going to run their money forward at 7% a year, and I want to be clear about why I am using that figure. The long-run historical return of the broad United States stock market is commonly cited in academic literature somewhere in the range of 7 to 10% before inflation. 7% is the conservative end of that range. It is not guaranteed, and your actual results will vary. Version 1. Robert and Patricia do what almost everyone does, which is nothing. They leave the account alone because touching it feels irresponsible. 7 years pass. At 7%, $1,200,000 becomes roughly $1,925,000 by the time they turn 73. That is the year the required minimum distribution rules take over. The Internal Revenue Service Uniform Lifetime Table gives a distribution factor of approximately 26.5 at age 73, so their first forced withdrawal is roughly $72,600. It arrives as fully taxable ordinary income, stacked on top of the $48,000 of Social Security, of which up to 85% becomes taxable once combined income clears the thresholds that have not been adjusted for inflation since 1983. Then the account keeps compounding faster than the withdrawal schedule drains it, so the required distribution grows every year. By their 80s, with the distribution factor shrinking as they age, they are pulling well over $100,000 a year of income they never asked for, sitting in the 22% bracket, with a Medicare income-related monthly adjustment amount now in the picture. Version 2. Same couple, same $1,200,000, same 7%. The only change is that starting at 66, they begin taking deliberate withdrawals from the traditional account each year and moving the money into a Roth account, filling the room I described at the top of this video and stopping at the top of the 10% bracket. For a couple in their position, that is roughly $47,500 at 0%, plus roughly $24,800 at 10%. $72,300 moved in a single year for a federal tax cost of about $2,480. Run that math, and the effective federal tax rate on $72,300 of retirement income is 3.4%. 3.4. Do that for the 4 years before Social Security begins, and they have moved roughly $289,000 out of the taxable column and into an account with no required distributions and no tax on withdrawals, at a total federal cost of about $9,920. Here is the comparison, stripped down to one clean sentence. $100,000 taken out of a traditional retirement account during the low-income window before Social Security and before forced distributions costs somewhere between $3,000 and $8,000 in federal tax for a typical couple. That same $100,000 taken out at 78, stacked on Social Security, stacked on a required distribution that is already filling the 12% bracket and dragging additional Social Security into taxable income as it goes, can cost $30,000 or more once you account for the effective marginal rate rather than the headline bracket. Same dollars, same account, same market. The rate changed because the year changed. If you are over 50 and reading a statement every quarter, this is the number that changes everything. And it is nowhere on that statement. People over 50 face this in silence, because the people they would naturally ask, the bank, the plan provider, the human resources office, are not the people who know the answer. Which brings me to the anti-diagnosis. The real problem is not what you think it is. Almost everyone who ends up in this situation walks into my office believing the problem is one of four things. They did not save enough. They started too late. They picked the wrong funds. Or the market did not cooperate. And every one of those four explanations puts the blame on their own behavior, which is why the feeling that comes with it is shame rather than action. None of those four is the mechanism. The couple I just described saved aggressively for 34 years, picked reasonable funds, and got a normal market. The reason version 1 costs them well over $100,000 more than version 2 has nothing to do with how much they saved or what they invested in. It has to do with which calendar years the withdrawals landed in, and that variable was never presented to them as a choice. This is not a discipline problem, it is a math problem. Specifically, it is a sequencing problem, and sequencing is a decision, which means it can be made deliberately instead of by default. The default setting on every traditional retirement account in this country is wait until the government forces you, and that default is the most expensive setting available, not because anyone chose it maliciously, because a default that requires no action is the cheapest thing for an institution to administer. Now the harder part, the financial services industry knew this and said nothing. And I want to be precise about how that silence works, because it is not a conspiracy. It is a set of incentives that produce silence as a byproduct. Your 401k plan provider runs a call center. The person on the phone is trained to process a distribution request accurately and to disclose the mandatory 20% withholding. They are not trained, not paid, and in most cases not legally permitted to advise you on your bracket, your Social Security taxation, or the 2-year look back that determines your Medicare premium. Your bank, when it opens a rollover individual retirement account for you, earns nothing from telling you to accelerate withdrawals. Its economics improve when assets stay parked. And the advisory model that charges a percentage of the assets it manages has a structural reason to prefer a larger account balance over a smaller after-tax obligation, because the fee is calculated on the balance, not on what you get to keep after the Internal Revenue Service is paid. Look at what the industry does emphasize instead. It sells the pursuit of extra return, better fund selection, tactical allocation, professional management. I read prospectuses. That is the job. And I can tell you the aspiration in those documents is almost always an extra percentage point or two of performance. Now look at the data the industry publishes about itself and then declines to put in its own marketing. The SPIVA Scorecard from S&P Dow Jones Indices found that over the 15-year period ending December 2024, not one United States equity fund category out of 22 had a majority of active managers beating their benchmarks. 0 out of 22. Over the 20-year period from 2005 through 2024, 94.1% of all domestic funds underperformed the S&P 1500 Composite Index. So, the industry spent decades selling you the chase for a percentage point. It statistically fails to deliver, while a 10 to 20 percentage point swing in your tax rate, one that requires no forecast, no manager, no market call, and no luck whatsoever, sat unmentioned in a tax table anyone can download for free. The window between when something is visible to those paying attention and when it becomes obvious to everyone is where generational wealth is built or lost. This particular window is open right now for anyone between retirement and 73. Let me tell you about David, because he is the reason I am this specific about it. David came to me at 69. Retired at 63 from a utility company after 31 years, pension eligible, careful with money in a way that was almost architectural, $1,100,000 in his traditional 401k. He was proud, and he told me this in the first 5 minutes, that he had not taken a single dollar out of that account in 6 years. He had lived on his pension and a savings account. He thought he was showing me discipline. He was showing me a receipt. 6 years. 6 annual resets of deduction room and low bracket room that he had every legal right to use, and he had used none of it. In his situation, the usable low-rate room ran somewhere around $60,000 to $70,000 a year. Call it $420,000 of room across those 6 years that could have moved out of the taxable column at a blended federal cost in the neighborhood of 4 to 5%. Roughly $18,000 of tax to permanently defuse $420,000. That same $420,000 is now going to leave his account under the required distribution rules, stacked on his pension and his Social Security, at an effective rate I projected between 28 and 34% once the Social Security taxation effect and the Medicare surcharge were included, somewhere between $120,000 and $130,000 of additional lifetime federal cost, on money he had already earned, already saved, already paid taxes to protect, and had never once been shown a choice about. I turned the second page of the projection around so it faced him, and he did not say anything for a long time. He was not ruined. He was going to be fine, and I told him that. He was crying because in 6 years of statements, 6 years of account reviews, 6 phone calls to a provider, and 6 tax filings prepared by someone who was not asked to look forward, nobody had ever told him there were free hours printed on the ticket. So here is what you do about it. And I am keeping the friction as low as I can, because a plan that eats a Saturday does not get done. Move 1 takes about 15 minutes and costs nothing. Pull up your most recent Form 1040. Find your taxable income, which sits on line 15. Write that number down, then subtract it from the top of the 12% bracket for your filing status, which for 2026 is roughly $100,800 for a married couple filing jointly and roughly $50,400 for a single filer. The difference between those two numbers is your unused room for this calendar year, expressed in dollars. That is the figure nobody has ever handed you. If you are retired, not yet 73, and not yet claiming Social Security, do not be surprised if that number lands somewhere between $60,000 and $100,000. Move 2 is a phone call that runs about 11 minutes. You are answering one question. Does your 401k plan allow an in-plan Roth conversion, or do you need to roll the money to an individual retirement account first and convert from there? When you request the transfer, use the words direct trustee to trustee transfer, because that phrasing is what keeps the mandatory 20% withholding from applying to money moving between retirement accounts. Move 3 is where you check the tripwires before you pick a number. 2 sets of thresholds decide whether your withdrawal is smart or expensive. The first is the Social Security combined income thresholds, still $25,000 and $34,000 for single filers, and $32,000 and $44,000 for married filing jointly, figures Congress set in 1983 and never indexed to inflation. The second is the Medicare income-related monthly adjustment amount, which for 2026 begins at roughly $109,000 of modified adjusted gross income for a single filer and roughly $218,000 for joint filers. That one is a cliff, not a ramp. $1 over the line triggers the surcharge for the entire year, and it uses your income from 2 years prior, so a conversion you do this year sets a premium you will see in 2028. And note the deadline, because this one catches people every December. A Roth conversion has to be completed by December 31st. There is no April 15th grace period the way there is with an individual retirement account contribution. If you are over 50 and reading this in the second half of the year, that calendar date is the whole ballgame. Now let me close out David, because he did not leave my office and go home to think about it. David was 69. 4 calendar years stood between him and his first required distribution at 73. 4 resets. In his situation, the usable room ran around $65,000 a year, so we mapped out roughly $260,000 of traditional balance moving into a Roth account across 4 years at a blended federal rate, a little under 9% once his pension income was stacked in. call it $23,000 of tax paid deliberately. In years he chose, at rates he could see in advance. That same $260,000, leaving under the required distribution rules later, would have run him somewhere between $72,000 and $88,000. He did not get back the 6 years he lost. He got the 4 that were left, and those 4 years were worth roughly $50,000 to $65,000 to him. The other version of David is the one who nods, agrees it makes sense, and does it next year. That version takes his first forced withdrawal at 73, having captured none of it. Robert and Patricia, the couple from the comparison, get the cleaner ending because they started at 66. $289,000 moved before Social Security began, for about $9,920 of federal tax. Left alone at 7%, which, as I said, is the conservative end of the long-run historical range for the broad United States market and not a guarantee, that Roth balance is roughly $797,000 by the time they are 85. No required distributions on it, no tax on the withdrawals, and available to whichever of them outlives the other, at a point when that survivor will be filing as a single taxpayer with roughly half the deduction and much narrower brackets. Here is the arithmetic of waiting one more year, and I want to be exact. One unused year of room at $72,000, taxed later at an effective rate near 28%, instead of the 3 to 4% you could have paid on purpose, is roughly $17,700 of additional federal tax on money you already own. Now let that $17,700 compound at 7% for 10 years, because that is what it would have been doing if it had stayed in your household instead of going to the Treasury. Roughly $34,800. 1 year, one decision you did not make. And unlike almost every other financial mistake, this one cannot be repaired later, because the room does not carry forward. People wait because they want to be certain first. Certain about tax rates, certain about the market, certain that the rules will not change. Certainty never arrives before the price does. So, the PAR method. 3 components: project, advance, route. P is for project. 20 minutes, 1 document, 1 number. Form 1040, line 15, subtracted from the top of your 12% bracket. That is your annual room in dollars. Do it once a year in the first week of October, which gives you almost 3 months of runway before the December 31st deadline. If the number is above $40,000, you have a live opportunity sitting there this year. A is for advance. Move the room this calendar year, not next. Direct trustee-to-trustee transfer, 0% withholding elected, tax paid from taxable savings, rather than from the transfer itself. If your room is $72,300 and you are a married couple, where both spouses are 65 or older, the first roughly $47,500 of that costs you 0 federal tax, and the next roughly $24,800 costs 10%. Which is about $2,480. Set the amount at 90% of your calculated room rather than 100%, so that a surprise $10.99 at the end of the year does not push you across a line. R is for route. Decide where the dollars land before you move them, because this is where people undo their own work. First choice is a Roth account because there are no required minimum distributions during your lifetime, and qualified withdrawals after 59.5 with the account open at least 5 years come out with no tax at all. If a Roth is not available to you for some reason, the second choice is a taxable brokerage account holding a broad, low-cost index fund. As one benchmark you can verify in about a minute, the Vanguard Total Stock Market Index Fund currently charges about 3 basis points, 0.03%, which is roughly $30 a year on a $100,000 position. What you should not do is park it in a standard bank savings account and call the job finished. The Bureau of Labor Statistics reported the Consumer Price Index for all urban consumers rising 4.2% over the 12 months ending May 2026, while the 10-year Treasury has been yielding somewhere around 4.5% and competitive high-yield savings accounts around 4%. Safety that does not beat inflation is not safety. It is slow wealth destruction. Now, the mistake that invalidates the entire method, and it is the one I see most often, because it is the default setting on the form. When you request a conversion or a withdrawal, there is a withholding election on that paperwork, and the pre-filled answer is usually to withhold the tax out of the money you are moving. Do not do that. If you convert $100,000 and let $20,000 be withheld for taxes, only $80,000 lands in the Roth. The $20,000 that went to the Internal Revenue Service left the retirement system permanently and never got sheltered, so you paid the tax and got nothing protected for it. If you happen to be under 59.5, that withheld amount also picks up a 10% early withdrawal penalty on top. Pay the tax from your checking or savings account from outside the retirement system and let 100% of the transfer land in the Roth. Same tax bill. $20,000 more permanently sheltered. That is the invisible villain in one sentence. Not a fee, not a fund manager, not the tax code itself. A pre-checked box on a form processed by someone who is not permitted to tell you what it costs. Inside a system whose cheapest default is for you to do nothing until the government decides for you. If you are going to run the PAR method on your own accounts this week, and I mean actually pulling the Form 1040, finding line 15, and writing down your room in dollars, comment PAR below so I can see who is doing the work, rather than watching someone else do it. Subscribing genuinely helps this channel keep producing this kind of line-by-line breakdown instead of the same recycled advice. And next week, I am taking apart the next layer of this exact problem. What happens to a surviving spouse who inherits all of this and files the following year as a single taxpayer with roughly half the deduction and dramatically narrower brackets? It is entirely preventable. One last thing, and I mean it. This is educational content built on publicly available data from the Internal Revenue Service, the Federal Reserve, the Social Security Administration, the Bureau of Labor Statistics, and S&P Dow Jones indices. It is not personalized financial advice, and it does not account for your situation. Every financial life is different. Your state's treatment of retirement income, your other income sources, your health, your marital status, your existing basis, all change the answer. Before you convert anything, withdraw anything, or change a contribution, sit down with a licensed professional, a certified public accountant, or a fee-only planner who can review the specifics of your circumstances. I am giving you the mechanism. The application belongs to someone who has your full picture in front of them.